There is a building in Washington, D.C. that most Americans could not find on a map. It has no products. It runs no elections. It manufactures nothing. Its employees are not voted in, not confirmed by popular opinion, and cannot be removed by anyone you have ever had the chance to vote for. And yet the decisions made inside that building determine whether you can afford your mortgage, whether your employer is hiring or laying off, whether your savings are growing or being quietly dissolved by inflation, and whether the economy you retire into looks like 1995 or 2009. The building is the Mariner, Eccles Federal Reserve Board building. The institution inside it is the Federal Reserve. And the Federal Reserve is either the most important and least understood institution in American life, or it is the greatest example of unaccountable power ever constructed in a democracy, depending on who you ask. By the end of this video, you are going to understand exactly what the Fed does, how it does it, why it has failed catastrophically at its two most important jobs at the two most important moments in modern history, and why the conversation about whether this institution should operate the way it operates is one of the most important conversations that almost nobody outside of economics Twitter is having. Let's start with the basics, because the basics are genuinely strange once you actually look at them. The Federal Reserve was created in 1913 by an act of Congress following a series of catastrophic banking panics in the late 1800s and early 1900s. The idea was straightforward. America needed a central bank, a lender of last resort, a stabilizing force, something to prevent the kind of bank runs and financial collapses that had periodically wiped out ordinary Americans throughout the 19th century. So Congress created the Fed, and then Congress did something unusual. It made the Fed independent. Not independent like a contractor, who still answers to a client. Independent like an institution deliberately insulated from the political pressures of elected government, so it could make economically rational decisions without worrying about the next election cycle. The theory was sound. Monetary policy requires long time horizons. Politicians think in 2 to 4 year cycles. Inflation and interest rate decisions play out over years, sometimes decades. You don't want a central bank cutting rates to make voters happy in October when the inflationary consequences of that cut won't show up until 18 months after the election. The independence was designed to protect you from short-term political thinking. That was the idea. Here's what independence actually produced. The Federal Reserve today is governed by a 7-member board of governors, appointed by the president and confirmed by the Senate. So far, so democratic. But monetary policy decisions are made by the Federal Open Market Committee, which includes the 7 governors plus the presidents of the 12 regional Federal Reserve banks. And here is where it gets interesting. The presidents of the regional Federal Reserve banks are not appointed by the President of the United States. They are selected by the boards of directors of the regional banks. And the boards of directors of the regional banks are partially composed of representatives from the commercial banking industry. The banks that the Federal Reserve is supposed to regulate have a formal role in selecting the people who set monetary policy. Read that again slowly. This is not a conspiracy theory. This is the legal structure of the institution as written in the Federal Reserve Act. The people being regulated have institutional influence over the selection of their regulators. And the people most affected by monetary policy, which is every working American with a job, a mortgage, a savings account, or a retirement fund, have no formal role in the process whatsoever. Now, let's talk about what the Fed actually does, because the mechanism is where the power lives. The Fed has 2 official mandates, 2 jobs. That is it. Maximum employment, price stability, employment up, inflation controlled. That is the entire job description of the most powerful financial institution on the planet. To achieve those 2 goals, the Fed has one primary tool: the federal funds rate, the interest rate at which banks lend money to each other overnight. When the Fed raises that rate, borrowing gets more expensive, mortgages cost more, car loans cost more, business loans cost more, consumer spending slows, hiring slows, inflation cools. The economy slows down. When the Fed cuts that rate, borrowing gets cheaper, mortgages become more affordable, businesses expand, hiring picks up, the economy speeds up. That is the lever, one lever, affecting every borrower, every saver, every business, every mortgage holder in America. Moved up and down by 12 people in a room, whose meetings are not broadcast, whose deliberations are not transparent, and whose decision rationale is released to the public in a carefully edited statement approximately 3 weeks after the meeting. 3 weeks, after the markets have already moved on whatever Jerome Powell said into a microphone for 45 minutes. Now, let's talk about the track record. Because the Fed's independence is justified primarily by one argument, that independent technocratic expertise produces better outcomes than politically influenced decision, making which is a reasonable argument. Unless the experts keep being wrong at the exact moments when being right matters most. Let's go to 2008. The housing bubble that nearly collapsed the global financial system did not appear overnight. It built over years. Mortgage originators were issuing loans to borrowers with no income verification, no down payment, and adjustable rates that would reset to levels the borrowers, mathematically, could not afford. Those loans were being packaged into securities and sold to investors around the world with AAA credit ratings. The entire structure was visible, documented, and discussed in academic papers, congressional testimony, and financial journalism for years before it collapsed. And in 2004, Federal Reserve Chairman Alan Greenspan gave a speech praising the innovation of adjustable rate mortgage products and their role in expanding homeownership. In 2005, Ben Bernanke, then a Fed governor, said the rise in housing prices largely reflected strong economic fundamentals. In 2007, as the first cracks were already appearing, Bernanke, now Fed chairman, told Congress that he did not expect significant spillovers from the subprime market to the rest of the economy. 9 months later, Lehman Brothers collapsed. The global financial system came within days of complete seizure. 8 million Americans lost their jobs. Nearly 10 million lost their homes. Household wealth in the United States declined by approximately $13 trillion. The two people most responsible for monetary policy and financial stability in the years leading up to the worst financial crisis since the Great Depression did not see it coming, or saw it and said something different. And the institutional response to being catastrophically wrong was not structural reform of the Federal Reserve's mandate or oversight. It was an emergency expansion of the Fed's power called quantitative easing, which is a phrase that sounds technical and was designed to sound technical because what it actually means is the Fed created money. Not printed in the physical sense. Created electronically. Between 2008 and 2015, the Federal Reserve expanded its balance sheet from approximately $900 billion to $4.5 trillion. It bought mortgage-backed securities. It bought treasury bonds. It injected liquidity into the financial system on a scale never attempted before. Did it work? The economy recovered. Eventually, the stock market recovered faster than the jobs did. Much faster, which is a pattern worth noticing. The Fed's crisis response in 2008 stabilized financial markets, primarily by making it cheaper for financial institutions to borrow and invest. The wealth effect flowed upward first and downward slowly. The top 1% of American households own approximately 38% of all stocks. The bottom 50% own approximately 1%. When the Fed's primary crisis tool is making stocks go up, the distribution of that recovery is not neutral. It is heavily weighted toward the people who are already the least harmed by the crisis. Now, let's go to 2021, because the story rhymes with the same institution making the opposite error. Coming out of the pandemic, the American economy was flooded with fiscal stimulus at a scale never seen in peacetime. Trillions of dollars injected directly into the economy through stimulus checks, enhanced unemployment, PPP loans, and expanded government spending, while the Fed simultaneously kept interest rates near zero and continued expanding its balance sheet past $8 trillion. Supply chains were broken. Demand was artificially elevated. The money supply was growing faster than at any point in decades. Every introductory economics textbook in the world has a chapter on what happens when you put this combination together. Prices go up. In early 2021, inflation began rising. By mid-2021, it was clearly accelerating. And in November 2021, Jerome Powell stood in front of Congress and described inflation as transitory. Transitory, temporary, expected to resolve itself as supply chains normalized and stimulus faded. By mid-2022, inflation had hit 9.1%, the highest in 40 years. The Fed, which had kept rates near zero while inflation built for over a year, suddenly began the most aggressive rate hiking cycle since the 1980s. Rates went from near zero to over 5% in approximately 18 months. And that rapid increase in rates is what turned a manageable situation into a housing affordability crisis that locked millions of Americans out of the mortgage market overnight, as 30-year mortgage rates went from 3 to 8%. The people most harmed by the inflation the Fed missed were lower and middle-income Americans, whose grocery bills and rent rose faster than their wages. The people most harmed by the rate hikes used to fight that inflation were first-time homebuyers and small business borrowers who found credit suddenly and dramatically more expensive. The people least harmed by all of it were the ones with fixed-rate mortgages already locked in, substantial financial assets that hedged inflation, and the balance sheet to wait it out. The pattern is not random. When the Fed makes a large error, the cost is not distributed equally. It is distributed in inverse proportion to wealth. The people with the least absorb the most, and the institution that made the error continues operating with the same structure, the same mandate, the same independence, and the same absence of accountability to the people who paid for the mistake. Now this is the part where I want to be precise about what I am and am not arguing. The Federal Reserve is not a cartoon villain. The people who work there are genuinely credentialed, genuinely serious, and genuinely attempting to solve extraordinarily difficult problems with imperfect tools and incomplete information. Monetary policy is not engineering. There is no controlled experiment. You cannot run the economy twice with different settings and compare the outputs. The Fed operates in real time with models built on historical data in an economy that keeps changing faster than the models update. Some degree of error is not just forgivable. It is inevitable. The argument is not that the Fed should be abolished, or that monetary policy should be run by a vote. The argument is that an institution with this much power, affecting this many people, making errors of this magnitude, should be subject to a level of democratic accountability, transparency, and structural oversight that currently does not exist. The Fed's Inspector General is appointed by the Fed's own Board of Governors. The Government Accountability Office is prohibited by law from auditing the Fed's monetary policy decisions. Congressional oversight consists primarily of the Fed chair appearing twice a year to testify before committees, whose members frequently do not understand the questions they are asking, and whose follow-up questions suggest they did not understand the answers. This is the oversight structure for the institution that controls the price of money for the largest economy in human history. A full audit of the Fed's monetary policy decisions has been proposed in Congress multiple times. It has never passed. The Fed opposes it. The argument against auditing is that political interference would compromise independence, which is a reasonable concern wrapped around a circular logic. The institution most needing accountability argues that accountability itself is the threat to good outcomes. Maybe that argument is correct. Maybe independence genuinely produces better results than the alternative, even accounting for the catastrophic failures. Maybe the counterfactual, a politically influenced Fed cutting rates before every election, is genuinely worse than what we have. That is a legitimate debate. But it is a debate that should be happening loudly and publicly, instead of being quietly settled by the assumption that the people inside the building are better positioned to evaluate their own accountability needs than the 250 million American adults whose financial lives are downstream of every decision they make. So tell me where you land on this. Do you think the Fed's independence is essential, and more oversight would just make monetary policy worse? But an institution this powerful operating with this little accountability is a democratic problem that needs to be fixed, regardless of the economics. Or C, it doesn't matter who runs the Fed because the system is going to produce the same outcomes either way, and the real question is just who absorbs the cost when it gets it wrong. Drop your answer in the comments. Because the most powerful unelected institution in America is counting on this conversation never getting loud enough to matter.